Now let us understand what is a bank reconciliation statement. What is a BRS? A bank reconciliation statement is, first and foremost, it is a statement. That means it is not an account. It is not the result of any double entry. It is just a statement. A statement could be a sentence. It is just a piece of paper where you indicate certain differences. So it is not an account. There is no double entry involved in a bank reconciliation statement. It is prepared by the account holder. Please note, it is prepared by the account holder and not by the bank. It is called a bank reconciliation statement, but it is not prepared by the bank. What does it do? It identifies the causes of difference between the bank balance as shown in the cash book and that shown in the passbook. Identifies the causes of difference between the bank balance as shown in the cash book and that shown in the passbook. Both are bank balances and therefore should ideally have been the same. But sometimes there is a difference and we want to know the causes of these difference by preparing a bank reconciliation statement. Also, extremely important is the fact that this is relevant only on a particular date. So a bank reconciliation statement is relevant on a particular date. It is a statement, not an account. It is a statement which is prepared by the account holder to identify the causes of difference between the bank balance as shown in the cash book and that shown in the passbook on a particular date. Why do we prepare a bank reconciliation statement? The importance of BRS. Why do we need a bank reconciliation statement? Let us consider the case of a businessman who at the end of the month, end of January, he has a lot of commitments in February. He wants to issue certain checks. He calls his accountant, asks for the cash book. He checks his balance and he sees he has 40 lakhs. That is more than sufficient. He wanted to issue a couple of checks, 20 lakhs and 15 lakhs. It should be fine. However, at the same time, he gets his bank statement. When he looks at the bank statement, he sees that he has only 7 lakhs. There is no way he can issue 2 checks for 20 lakhs and 15 lakhs. He has no idea what has happened, where the funds have gone, why the cash book says 40 lakhs and why does the bank statement say only 7 lakhs. In panic, he calls his cashier, tells him he does not understand what has happened. The cashier sends for the accountant and they sit together and draw up a bank reconciliation statement indicating why there is a difference in the balances of both books. Is there a fraud? Is there an error? Or are they all timing differences? Differences which are legitimate. Let us try and see what kinds of errors are located. So let us understand the importance of a bank reconciliation statement. It would help in locating errors. If there has been an error made by the accountant while preparing the cash book or the bank while preparing the customer's account in its books, they would be identified by preparing a bank reconciliation statement. Like we were talking about the businessman, very often these huge differences could be due to undue delay in clearing of checks. Let us say the reason that there was such a big difference was due to 4 checks being deposited of 10,000 each, none of 10 lakhs each, which were not cleared. But why was it not cleared? It is in the process of clearing And like we have discussed before, it is possible that we deposit a check on day 1, but the check gets cleared and money is credited into the account only on day 7. Some of these checks, if they are outstation checks, checks where the customer's account is in one city, in one state, while the payer's account, bank account or bank is located in another city, in another state. These would be outstation checks, and it takes sometimes nearly 2 weeks to get such checks cleared. When we prepare a bank reconciliation statement, we identify such checks which are held up in clearing, and if there has been an undue delay, we are able to locate the same and try to ascertain the reasons. Prevent fraud. It is quite possible that our cashier has been instructed, let us say, to deposit funds at the end of each day into the bank. The cashier has religiously recorded a deposit of different sums of money every day into the bank. However, if he does not deposit this cash into the bank, but siphons it off, but enters into the cash book so that the proprietor has no knowledge of the same. While preparing a bank reconciliation statement, while comparing the balance in the passbook with that in the cash book, such frauds could easily be identified. Another importance of the bank reconciliation statement is to arrive at the correct bank balance. At the end of the year, what should be the balance, bank balance, that should be shown in the balance sheet? Is it the one which is shown as per the cash book? Is it the one that is shown as per the passbook? With the help of the bank reconciliation statement, we arrive at the correct balance which should be reflected in the balance sheet. We consider errors we have made. We consider all incomes and expenses which are relevant for that particular year. Pass necessary entries in the cash book and arrive at the correct bank balance. We will discuss this in detail when we discuss the adjusted cash book.